You spent 2 hours grinding the salesman for $500 off the car. And the dealership still made $3,000 off you before you drove away. How? Because here's the secret nobody tells you. The dealership makes almost nothing on the car itself. On many new cars today, the profit on the metal is a few $100s, sometimes less. In late 2025, industry data showed the average front-end profit on a new car dropped to around $280. $280. That's less than a set of decent tires. But wait, if the car barely makes the money, why do dealerships look like palaces? Why the marble floors, the free coffee, the glass showrooms? Somebody is paying for all that. And I'll give you a hint. It's you. Just not in the way you think. Welcome back to Mr. Money Boss. Today I'm going to show you where the money actually moves inside a dealership. And once you see it, you'll never sit in that little back office the same way again. Because the game isn't the car. The game is what happens after you agree to buy the car. So let's start with the two halves of every deal. Dealers split their profit into front end and back end. Front end is the profit on the vehicle itself, the difference between what they paid for it and what you paid for it. Back end is everything else. The loan, the warranty, the add-ons, the protection packages, all of that gets handled in a separate room called the F&I office, finance and insurance. Now here's the number that should change how you shop forever. Recent industry data shows finance and insurance profit running close to $2,000 per vehicle. The big publicly traded dealer groups have reported over $2,500 per car from F&I alone. Read that again. A few $100s on the car, $2,000 or more in the back office. The car is the appetizer, you are the main course. Therefore, everything about the dealership experience is designed to move you into that back room in the right mood. Tired, relieved, ready to sign anything just to go home. That 2-hour negotiation over the price. That's not an accident, that's a feature. Because a worn-down buyer doesn't read paperwork carefully. But how exactly do they turn that back room into a money machine? 3 main ways. And the first one is completely invisible. It's called dealer reserve. Here's how it works. When you finance through the dealer, they send your application to their network of lenders. A bank comes back and approves you at what's called the buy rate, say 6%. That's the rate the bank actually wants. But the dealer doesn't have to show you 6%. Most lenders allow the dealer to mark that rate up, typically by 1 to 2.5 percentage points, and keep the difference. So the dealer prints out your paperwork at 8%. You think the bank gave you 8. The bank gave you 6. The dealer pockets the spread. On a $40,000 loan over 6 years, a 2-point markup can quietly cost you well over $2,000 in extra interest for filling out a form. And here's the part that stings. They are not required to tell you the buy rate. You will never see it unless you force the issue. This is legal, this is normal. This happens thousands of times a day across the country. Therefore, the person arranging your loan is not your advisor. They're a commissioned middleman standing between you and the bank. But the interest rate is only weapon number 1. Weapon number 2 is the menu. When you sit down in the F&I office, they'll slide a screen or a sheet in front of you. Extended warranty, gap coverage, paint protection, fabric protection, wheel and tire packages, key replacement. It looks like a helpful checklist. It's actually the highest margin shelf in the entire building. Take the extended warranty, officially called a vehicle service contract. The dealer buys it wholesale from a provider. Then they sell it to you with a markup that's often 50 to 100% or more. A contract that cost the store around $1,000 might land on your paperwork at $2,000 or even $3,000. And the price is made up on the spot. Same product, different customer, different number. Then there's gap coverage. Gap pays the difference if your car gets totaled while you owe more than it's worth. The concept is genuinely useful for some buyers, but the dealer version is usually marked up several times what it costs them. And here's what they won't mention. Your own car insurance company often sells similar coverage for a fraction of the price. Industry reporting shows service contracts and gap now make up most of the money dealers earn in the finance office. Most of it. Those two products are carrying the whole department. And paint protection, fabric protection. That's often a bottle of sealant and 30 minutes of labor sold for hundreds. Therefore, when the finance manager says they're just going over some options, understand what's really happening. You're at the highest pressure point of sale in American retail. But there's a third weapon, and this one is a question. A single question that hands them control of the entire deal. What monthly payment are you looking for? Sounds friendly, sounds helpful. It's a trap. Here's why. The moment you say $400 a month, you've stopped negotiating the price of the car. Now you're negotiating one blurry number that hides 4 separate numbers inside it. The vehicle price, the interest rate, the loan length, and the add-ons. Watch how the trick works. Say they hit your $400 target. You feel like you won. But they got there by stretching the loan from 60 months to 78 months. Then they tucked a marked up warranty and a marked up rate inside the payment. The monthly number stayed pretty. The total cost exploded. You could easily pay $4,000 or $5,000 more over the life of the loan and never feel it happen. Because payment buyers don't do math. Payment buyers feel. And dealerships know this better than anyone on earth. Therefore, never answer that question with a number. Ever. Your answer is simple. I'm focused on the out-the-door price of the car. Full stop. Okay, so now you can see the whole machine. Thin profit on the metal, fat profit on the money. Which means most car buying advice has you fighting the wrong battle. People show up armed with pricing apps, ready to go to war over $800 on the sticker. Then they hand the dealer $3,000 back in the finance office without blinking. It's like guarding the front door while the back door is wide open. So here's how you actually win. And it comes down to order. The sequence you do things in matters more than how tough you negotiate. Step 1. Before you ever touch a dealership, get pre-approved somewhere else. Your bank, a credit union, an online lender. Credit unions especially tend to have sharp rates on car loans. This takes maybe 20 minutes, and it changes everything. Because now you know your real rate, your true number based on your actual credit. The dealer can't mark up what you already have in your pocket. And here's the beautiful part. Now the dealer has to compete for your loan. If they can genuinely beat your credit union's rate, fine. Let them. You win either way. But they only sharpen their pencil when they know you have options. Step 2. Negotiate one number and one number only. The out-the-door price. That's the total with taxes, title, and every single fee included. Not the monthly payment, not the discount off sticker, the final, all-in, write the check number. This kills the shell game instantly. There's nowhere left to hide a fee when you're comparing final totals. Step 3. In the finance office, decline the menu, politely. No paint protection, no fabric shield, no nitrogen in the tires. If you genuinely want an extended warranty, you can buy one later, and you can shop it against other providers instead of taking the first inflated quote. If you need gap, call your insurance company first. Same protection, way smaller price. Step 4. Read every line before you sign. Add-ons have a funny way of appearing in contracts that were never discussed out loud. If something's on there you didn't agree to, have it removed. They will remove it. They just hope you won't look. Therefore, your entire strategy is one sentence. Bring your own financing, negotiate the out-the-door price, and treat the back office as a signing room, not a shopping room. That's it. That's the whole cheat code. Now let me zoom out for a second. Because once you understand this model, every weird thing about dealerships finally makes sense. Why will a dealer sometimes sell you the car at a razor-thin price? Because they expect to make it back on your loan. Why do they get visibly annoyed when you show up with a check from your credit union? Because you just closed their favorite profit center. Why does the service department schedule you for so many recommended maintenance visits? Because parts and service are another massive earner. American dealerships pulled in over $140 billion from service, parts, and body shops in a single recent year. The car sale isn't the business. The car sale is customer acquisition. You're not buying a car from them. They're buying a customer. A customer who pays interest for 6 years and comes back for oil changes. And when you finally see it that way, the fear disappears. That little office stops being intimidating because you know their playbook better than they expect you to. You walk in with your own money, your own number, and your own plan, and there's nothing left for them to work with. So next time someone brags about knocking $500 off the sticker, smile and ask them what interest rate they signed, because the sticker was never where the money was. The dealership doesn't sell cars for a living. It sells loans, and the car is just the hook.